Today, folks, I just did the unthinkable for you dividend fans out there. I sold my Telus position. It was incremental, it was very small, only a few $1,000s worth as a position to keep my eyes on the space heading into earnings season. And I think the canary in the coal mine is kind of giving us some hints to what's going on with the recent earnings from Bell, Rogers, and I want to break down what these stocks are doing because Bell is not going to cut their dividend like so many people say they need to because their cash flow can't cover it. And I want to explain to you why they're not going to cut the dividend. And this plays into the other mega telecom giants. However, this does not mean that I'm not going to buy Telus back. Telus might be more resilient than the other telecom providers. I won't know, but I do not want to wait to see what those earnings are when we've seen some pretty abysmal results coming out of Bell thus far. Now, if you are a long-term investor, I believe these oligarchies, these few companies that control the entire telecom space aren't going anywhere anytime soon. We're just in a rough patch, but as an investor that tries to outperform and is very mitigated with individual stocks, I want to make sure I'm very confident in where the company's going. And right now, in the short term, at least for this earnings, my confidence has been lowered, and I'll explain to you why. But first and foremost, if you take a look, Telus was one of the few gems today that didn't tank miserably with the rest of the telecom giants, which I kind of just use as a sign to say, hey, people have a little bit more confidence here, but I'll use that confidence to sideline. I don't mind missing out on a few percentage points of gains if the stock does recover and show some resilience. It's better than taking maybe a 10% hit here after earnings, which is what we've been seeing. I mean, Rogers is down 7% today. Bell's been bouncing around down about 5 to 7%, depending on what point of the day you were looking at it. If we take a look at the 1-year chart on these guys, it's year to date, we were in a really good spot for the most part, right? Like these things started to recover up till recently, and we're still in this downward spiral of this really hard to want to catch a falling knife. Like I'm really looking for these true signs that these stocks have bottomed. And when that day comes, these will truly be buying opportunities. But like I said, I am kind of finicky with my individual stocks. I believe in long-term cost averaging into indices like VDY that hold these positions already. I do have exposure already, and those will automatically weight them based off their performance. So no matter what, I'm getting the best performing stocks. But when you're buying individual stocks, you are taking on a lot more risk, and it's not risk that I want to overly associate myself with, presuming there's just too much risk in the short term. If we take a look at my TFSA today, VDY, is one of my largest positions in here that I'm up 7% on. I only took about a 2% gain, 2.5% gain on Telus because I did buy it right around that $20 mark, and I think we sold it today at whatever it was trading at a little bit earlier on. I think Telus was at what? It's been hovering around that $20, $21 range, so barely huge returns here. I'm not like excited about selling it. Don't get me wrong from that aspect. But again, if you take a look at my TFSA, most of my stock interest is still in Google after the drop. I still like the S&P, and I'm just a lot more cautious about individual stocks today than I used to be. It's just how the market is, and at the scale of our portfolios, this is where I sit comfortably. But we'll come back to this in a moment. What I really want to do is kind of implement the idea of why these companies are not cutting their dividends. And Bell recently announced that they are opening up a reinvestment plan. There are very few companies in Canada that will offer you a discount to reinvest your dividends. Most companies do offer DRIPs, the dividend reinvestment plan, where without paying commissions or fees, every time you get a dividend, they'll just automatically transfer that to shares. But usually they're open market shares and they're not offered at a discount. Now, Bell literally just announced that they're going to issue a 2% discount to apply, starting with reinvestment of dividends payable on January 15th. The reason that they're not cutting the dividend with cash flow concerns is because they know most people will opt into getting a discount and will want to reinvest. And when doing so, Bell is going to issue you new shares. So they're going to pay you a dividend. They're going to take that dividend back and issue a new share, basically just giving them free cash to use and diluting you as a shareholder. Now, this is not a very appropriate, and it is a very convoluted thing that shows some really underlying concern with the company. And if we just read into this, and essentially, basically, and subsequently, if I said that correctly, until further notice, common shares distributed under the DRIP will be issued from the Treasury at a discount of 2% to the average market price. The discount will not apply to purchases made pursuant to the optional cash payment. This is really intriguing to me. And if we take a look at the other companies like Rogers, for example, they've kind of announced they're doing something similar, but it's a little bit more convoluted because they said basically, in accordance with Rogers' amendment and the restated dividend reinvestment plan, under the plan, the board determines whether the additional Class B shares will be purchased on the open market or issued by Rogers from the Treasury. The plan permits at the board's discretion a small discount when shares are issued from the Treasury under the plan. In connection with the quarterly dividend, Class B shares will be issued by Rogers under the plan from Treasury at a 2% discount from the average market price. This is a very fascinating way to get investors excited and to keep them in the stock. This is why I always state that you should be a total return investor, because you might get excited about this, but it shows that there's underlying concerns with the business. Now, Telus, on the other hand, they haven't been doing this, right? Like, they haven't offered a discount. They're not issuing shares on dividend reinvestments, but they have been increasing the dividend on the back of a rockier telecom market. They just recently increased the dividend to 0.4 cents from 0.38. But what Telus does over these other companies is they have been issuing shares fairly consistently, right? And regardless whether they pay you out a new share or they just issue new shares on the public market, that's kind of what they're doing to kind of continue to build cash. Now, these companies usually do issue shares to reinvest into infrastructure. Telus has a lot of infrastructure they've been reinvesting into since 2020, which is probably what led to the increase of share issuance. And I have nothing against this if it's done prudently and it offers further cash flow and further growth to the business over time. And I have good reason to believe that these companies will start to stabilize and do exceptionally well over the long run. But in the short term, this volatility, this share issuance, these are things that are going to continue to deteriorate the business on the back of a slower economy when it comes to population growth, which we'll talk about in a moment. There's still a lot of concerns around, infrastructure, competitive pricing. So we'll get into that, because Bell hasn't really been issuing shares up till recently. Like, this new dividend issuance thing is going to start diluting. Rogers, again, something that they haven't really been doing as much over the last few quarters in 2024, but could likely be something they're going to do in the future. So I really want to talk about the fundamentals, the guidance, what is leading to these stocks dropping, and it has everything to do with future expectations. Firstly, they're saying that their free cash flow has been decreasing to $874 million on higher interest paid and timing of working capital, including impact of the Canada Post strike and the cash tax installments. Again, we're still getting detrimented by higher interest payments, but luckily, if we continue to see aggressive cuts, this could be a headwind that starts to alleviate coming through the latter half of 2025 as we start actually seeing it hit the bottom line. I want to read to you what the CEO said that, again, offers some concerns into the future. The company said it expects 2025 revenue in the range of 1% increase to a 3% decline. It forecast a decline in adjusted earnings per share between 8 to 13%. The wide range is designed to accommodate for macroeconomic pressure and competitive pressures that we've seen in the pricing over the last 18 to 24 months, said the chief executive officer. The company cited continuing competitive wireless and broadband pressure, lower subscriber loading, higher media cost, increased interest expense, and a higher number of common shares outstanding due to the implementation of a discounted dividend reinvestment plan. As we stated, this was offset by lower planned capital expenditures resulting from a slowdown in its fiber build and certain efficiencies, which it said would drive free cash flow growth of between 11 to 19%. In its fourth quarter ended December 31st, the telco added 56,000 net new postpaid wireless customers, down 56% from the 128,000 customers added last year. Analysts had expected the company to add 64,000. It's been a highly competitive environment with the lowest pricing we've ever seen. And this is a fine reminder that if you are stuck on a fixed plan with your telecom provider, call in right now and get a discount here, folks. It doesn't matter what telecom your provider you're with. If some other telecom provider is offering a cheaper version of your same phone plan, call your current one and get on the retention line and say, if you don't discount me, I'm leaving. This works all the time. You got to be aggressive with these guys to get these kind of deals, and at least you can save it on your bottom line if you're not saving it in the stock price. But this paints a very non-rosy picture, right? And honestly, I think they're going to do better than perhaps what they're stating here. This is why they're offering really low guidance, because I have some good reason to believe that they can still do better than this. But if we do a quick comparable, you can see the guidance here is not great, 3 to 1%, down 2% to 2% on adjusted EBITDA growth. Like, nothing here is screaming, oh, this is such a great company to own. But with a lot of these concerns being over-exaggerated in the stock price, again, eventually we're going to come out on the other side of this. You just have to be patient and be a long-term investor, or like me, wait for the turnaround. These aren't stocks that once the turnaround starts are going to skyrocket up 100% overnight. You'll be able to buy in the the cyclical return that follows. And I'm very patient to wait for that day. When we take a look at Rogers, it's almost the same sort of deal. Total revenue guidance for 2025 is in the 0 to 3% range, an increase of 0 to 3% on EBITDA. We are not talking about anything astounding here. Free cash flow could be worse than even that of last year. So one of the big concerns that's driving a lot of this is the fact that we are cutting off immigration growth for like the next 2 years because of obviously inflation, the concerns around housing, and so much going on in the Canadian economy. So there's a lot of headwinds. This was not the quarter of excitement that I was anticipating to be the bottom, but it doesn't mean it's not the, it doesn't mean the uncertainty is playing into Telus either. I'm not sure why Telus has been able to stride through this. It might be because of their security business, their telehealth business that is growing. I believe they're in a much more stable industry than Rogers and Bell, which are more focused on media when it comes to Crave, when it comes to their legacy media business. I hate Rogers when it comes to their sports media division, though that's been doing fairly well. I really like Telus, and I think it has a much more fundamental base and a reliable business, which is why I think the performance has been a bit exceptionally better than Bell as an example, but that doesn't mean that they're not out of this murky water, right? So when it comes to my portfolio positioning overall, like I said, I like indices and market cap weighted ETFs like VDY because they alleviate the stress of these concerning businesses. When they start to do not so well, they get de-weighted, and when they do start to perform again, they can re-weight themselves up, and that way we always have the best performing stocks in the upper echelons of the ETF. And I very will likely, if I do not find any, really good, stocks in the telecom sector, I don't mind just throwing that money into VDY and continue to cost average, but I still see some great opportunities out there. I've talked about Waste Connection, some other stocks that do offer better total returns that I might take into consideration that aren't weighted in VDY, as I'm still looking for a couple Canadian stocks to help diversify. I've also been expanding into looking at some Chinese dividend stocks. The foreign markets look like they're starting to recover here, and I think we could see the turnaround with the exception of perhaps some volatile, political, tariffs and stuff like that could be some concern, but fundamentals are starting to improve in the global markets, which is why you should probably just cost average into something like XEQT. Forget the nonsense of what I'm doing and just buy one stock that gives you exposure to all of these in a market cap weighted and a passively weighted fashion and mechanism. It's far more brilliant. It's far less stressful. But if you're here for the entertainment like I am, maybe make that most of your portfolio and see if you can outperform with some individual stocks like I try to do. But I will pass that question off to you. I'd love to know how you're navigating this, your thoughts around these telecom giants and everything else in that comment section below.